For most of the trading day, the market had been merely nervous. Greece was on fire, the euro was sliding, and traders were watching their screens the way you watch a storm you think is going to miss you. And then, in about the time it takes to microwave a burrito, nearly $1 trillion of American stock market value simply stopped existing. No war, no bankruptcy, no headline. Accenture, a Fortune 500 company, briefly traded for 1 cent. Somewhere, a share of Sotheby's printed at over $100,000. The whole thing lasted about 36 minutes. And here's the part nobody wants to say out loud. The market didn't break because someone was evil. It broke because it was working exactly as designed. Let me set the table because the setting matters more than most people tell you. May the 6th, 2010 did not begin in a vacuum. The European debt crisis was at full boil. Greece looked like it might default and drag the euro down with it. By early afternoon, fear was already priced in. The VIX, the market's fear gauge, was up more than 20% from the open. The Dow was already down around 2.5%. Nothing catastrophic, just a heavy, jumpy, thinning tape. That last part is the one to hold on to. Liquidity was thinning. The buyers were quietly stepping back. On a calm day, that's invisible. On this day, it was the dry brush before the spark. Because at 2:32 in the afternoon, someone lit a match, not out of malice, out of routine. Here's how a routine hedge turned into a $1 trillion hole. Follow the chain, because every link is boring on its own and lethal in sequence. Link 1, the volume-blind algorithm. A large fund, later identified by the press as Waddell and Reed, wanted to hedge a big position. So it did the most normal thing in the world. It handed the job to a computer. 75,000 E-mini contracts, roughly $4 billion. Now, $4 billion sounds enormous. It isn't, not really. That's about 1.3% of the day's volume in that contract. On a normal day, invisible. The problem wasn't the size, it was the instructions. The algorithm was told to sell until the job was done, targeting 9% of the trailing minutes trading volume without regard to price or time. Read that again. No price limit, no time limit, just match 9% of whatever's trading, sell into anything. Do you see the trap already? The algorithm's speed was tied to volume. So the more frantic the tape got, the faster it dumped. Most engines like this would spread that order across 5 or more hours. This one emptied it in about 20 minutes. Link 2, the buyers who turned into sellers. At first, the high-frequency traders did their job. They bought the flood of selling. That's what they're there for, to absorb. But high-frequency firms don't hold inventory. They run flat, in and out in milliseconds. Once their tanks filled and hit their risk limits, they flipped. They stopped buying and started selling aggressively to dump what they'd just taken on. And other liquidity providers did the ugliest, most rational thing of all. They simply widened their quotes and stepped away. The depth that looked so reassuring a minute ago, it was never a wall. It was a promise, and promises get canceled in microseconds. Link 3, the hot potato. This is the part I want you to actually feel. With the real buyers gone, the machines started trading with each other. In 14 seconds, high-frequency accounts traded about 27,000 contracts, roughly 49% of all volume. And here's the number that should stop you cold. 27,000 contracts of activity. 200 contracts of anything actually happening. They were passing the same hot potato back and forth. The tape screamed liquidity and there was almost none. Worse, remember our first algorithm. It measured volume. So this fake, frantic, going nowhere churn told it to sell even faster. The machine was feeding itself. Link 4, the contagion. The E-mini S&P 500 future is the reference price for the entire equity market. When it collapsed, It dragged the SPY exchange-traded fund down with it, and index arbitrage transmitted that shock into hundreds of individual stocks. Market makers in single names suddenly couldn't price anything. Their reference point was in free fall, so they pulled their real quotes too. Link 5, the stub quotes, the penny and the six-figure prints. Now we get the freak show numbers. Market makers are obligated to always post a two-sided quote, so when they wanted out but couldn't legally go dark, they posted placeholders, stub quotes, a bid of 1 cent, an offer of $100,000, prices never meant to trade, except the real liquidity was gone. So incoming market orders swept all the way down and hit the stubs. 8 major companies momentarily priced at a penny. Others, Sotheby's, Apple, Hewlett-Packard, shot up past $100,000 a share. And let's kill this myth on contact. The market never thought Apple was worth $100,000. That's not a valuation. That's plumbing. It's the artifact of an empty order book meeting a placeholder, and many of those prints were later canceled. Meanwhile, a real Dow component, Procter & Gamble, genuinely fell nearly 37%. And that's the kind of move that actually craters an index. Link 6, the thing that stopped it. At 28 seconds past 2:45, a piece of infrastructure most people had never heard of did its job. The CME stop logic tripped and paused trading in the E-mini for 5 seconds. 5 seconds. That's it. Just long enough to break the reflex loop, to let the algorithm stop force-feeding supply and let real buyers gather their nerve. Trading resumed 5 seconds later, and the market began to climb out. Within about 20 minutes, it had clawed back most of the roughly 600-point leg down. And note what that was, a futures market pause, not an equity circuit breaker. The stock market safeguards everyone assumes we're watching. They were built for slow, daily crashes. They never even woke up. So who do we hang for this? For 5 years, the answer was nobody in particular. The government's own September 2010 report on the crash described the mechanism I just walked you through. It named a large, fundamental seller. It did not name a mastermind, because it didn't find one. Then in April 2015, the FBI arrested a 36-year-old day trader named Navinder Sarao, trading from his parents' house in a London suburb. Sarao was a spoofer and a prolific one. He ran a layering algorithm, stacking big sell orders just above the market to fake selling pressure, then canceling them before they filled. On May the 6th, he ran it for hours. It was real. It was illegal. And here's what makes him the perfect scapegoat. He did it on more than 400 trading days. The market flash crashed once. Read the Justice Department's own words carefully, because they did. They said his conduct was a cause, among other factors, of the flash crash. Not the cause, a cause, among other factors. That is the most heavily hedged sentence a prosecutor will ever write, and they wrote it on purpose. Academics went further. A peer-reviewed 2017 deconstruction argued Sarao wasn't a but-for cause at all. That the crash is fully explained by stressed macro conditions, a volume-blind mega-order, and a self-feeding machine. The spoofer distorted the book. He did not, by himself, empty it. He pleaded guilty in 2016 to 2 counts, spoofing and wire fraud, down from 22 charged. He cooperated extensively. And in January 2020, the judge gave him 1 year of home confinement. No additional prison time. The man the tabloids call the architect of a $1 trillion crash went home to his parents' house. So what did we actually do about it? First, that night, the exchanges canceled the mess. More than 20,000 trades across more than 300 securities. Any print 60% or more away from its pre-crash price, wiped from the record. Then came the machinery of prevention. Single stock circuit breakers to pause a stock on a 10% move in 5 minutes. A ban on stub quotes. No more penny and 100,000 placeholders. Limit up, limit down. price bands that halt a stock that runs too far too fast, rebuilt market-wide circuit breakers, rebased to the S&P 500 at 7, 13, and 20%. And a consolidated audit trail because it took regulators months to reconstruct 36 minutes. They didn't even have a unified tape. Look closely at that list. Not one of those reforms makes liquidity real. Every single one is a pause button. Here's the trader's eye view. The thing I actually want you to leave with. The order book is a confidence trick. Display depth, all those stacked bids that make a market look bottomless, is a set of promises made by people who are free to break them in microseconds. It is deepest exactly when you don't need it, and it vanishes the instant you do. On May the 6th, 2010, we didn't witness a market failing. We witnessed a market revealing what it had been the whole time. And notice what the fixes concede. We never made the liquidity real. We just installed pause buttons, ways to stop the clock the moment the illusion breaks. The 2015 exchange-traded fund flash crash, the mini crashes since, the AI-driven order flow layering on top of all of it now, they all whisper the same thing. The fragility didn't get fixed. It got scheduled around. We went looking for a villain and found a mirror. The market wasn't sabotaged that day. It was just, for 36 minutes, honest.